Welcome to the Justin Ng Show, where real entrepreneurs and investors reveal how they turn humble beginnings into high-impact ventures. From bold moves to capital raises, we unpack what it really takes to build and scale greatness. Let's go check it out. What's up, everyone? Today, in the Justin Ng Show, I'm joined by Brad Dahmer, finance pro turned capital raising machine at Kingston Realty Group. We're diving into his journey from Wall Street roots to raising capital for major projects like Sparrow in Vegas gas stations and the latest Bojangles deal. From private equity strategy to real estate execution, this episode is full of insider knowledge and investment game. Let's go. All right. Well, thank you so much, Brad, for joining me today on my podcast. I know you drove really far, but thank you so much again for your time today.
Yeah, stoked to be here.
Yeah, thank you. So, for me, how I was mentioning earlier, tell us your story, how you started and where you came to right now as a doing in equity, private equity with a real estate development team. Tell us the story from your humble beginnings up to where you are right now and what kind of amazing projects you're working on. And yeah, if we can start with that.
Yeah, sure thing. Yeah, so just kind of from the start, I was raised here in Vegas, and my mom was a realtor back in the early 2000s. So right in the run up into the huge great financial crisis, and so I saw entire neighborhoods just get foreclosed, and so that was really interesting to me. Like my brother-in-law and my sister. They moved into a neighborhood actually just kind of down the road from here. And that whole neighborhood got wiped out as well. And so suddenly my mom had nothing, to do, right? There's no one buying any real estate. There's nothing happening. The entire market came to a gridlock. And my dad also worked in finance. And so I started asking him questions like, hey, why is this happening? I was only 14. I really want to understand what was causing all this to happen all at once. And so that's what really kind of kicked off my passion in finance and markets and investing as well. So I started learning about the stock market. He was kind of showing me how to pull up different quotes and everything online, and I just fell in love with it. Like the idea of I can take $1 or some amount of money, put it somewhere, invest into some asset class, and get more money out of it. Like that whole concept to me was just insane. I was like, I love this. Uh-huh. It was electric.
Yeah.
And so then I learned more about what my dad did. He was a founder of a bank actually here locally called Credit One, and they're owned by a private equity group. And so I kind of had some base information, kind of some base learnings about public markets, and then I started kind of learning about private markets as I got older. And it was just fascinating to me that you can just take on a huge amount of debt, buy an entity, and thank you, and use that leverage to basically generate massive returns. And so the deeper I went down there, the more I realized, okay, I need to go study finance and economics when I go to school. Now, I wasn't a very good student in high school. I graduated from Silverado High School here. I went, public school route. I think I had a 2.5 GPA, just very bad GPA. And it was just because I have ADHD, and so got that problem fixed. I went to college and became a 4.0 student overnight.
Nice.
And just fell in love with finance and economics. It's not just one thing to get your degree in it, but just to become an absolute lifelong student in it. So when I was at Utah State, where I went to my undergrad, I was just pursuing that as hard as I could, and learned that, hey, to get into these really cool investing roles, you have to go through an investment bank. So the Wall Street banks, they take on thousands of new analysts every year. And usually those positions are only 2-year positions. And the beauty of it is you learn what a good deal is, what a bad deal is. You learn kind of the whole capital raising process, learn how to merge companies together. And you get kind of a world-class training in how to invest in kind of the concepts of financial markets. And all the private equity companies, all the buy side firms like hedge funds, venture capital, private equity, real estate, they recruit heavily from these investment banks because it's so much cheaper to have the bank spend the money to train the analyst than to train them yourself.
Gotcha.
So I learned that early on, and so I went and pursued a job in investment banking. The difficult part is it's hyper competitive to get in.
Mm-hmm.
You have a greater chance of getting into Harvard than most investment banking programs.
Wow.
And so I thought I had it in the bag. You know, is my senior year, my last semester. I had like 3 interview processes with Goldman Sachs, you know, a lot of the other top investment banks. And so I was like, man, I'm going to do it. And then I failed flat on my face.
Wow.
You go through the interview processes of these banks. You get ultimately to the last round, which is called a super day. They bring you in. You're there all day. You're just getting peppered with questions nonstop. And, you know, I thought I did really well, but, you know, unfortunately, you basically have 10 of my exact carbon copy, except they all went to Harvard or Stanford or Wharton, all these top schools. And so unfortunately, I just didn't check that box and I didn't make it. I fell flat on my face. And so I had to take a job that was not really related to what I actually wanted to do. And it felt like my dream was starting to slip away. And so at night I would come home and I would just spend like hours. I'd get home at, 5:30 and I'd work till like midnight, just networking, trying to get in any way possible to an investment banking program. And after about 2 years, I finally got the job. And I was like, oh my gosh, this is amazing. Like all this hard work. And then the real hard work started because these investment banks will grind you like 80 to 100 hours a week. Wow. Because they know that, hey, for every spot, there's 400 people that want to come take that spot. So if they burn you out, well, guess what? There's a whole Rolodex of people behind you that are happy to take that spot. So, I was just, really, really working my tail off, working as hard as I could. You'd start around like 8 a.m. Some nights you'd be up till like 4 a.m., and then you wake up the next day and do it all over again for 2 years. So after that, I got recruited into my current firm. And they're a real estate private equity fund. So it's like, oh my gosh, like I finally made it to the buy side, like the coveted role. Right. And so I started out on acquisitions right in 2021 when interest rates were 0. So we were going gangbusters. Like anything that moved, we bought it. In that first year, I bought over $1 billion of real estate on behalf of the firm. And so that really is like a trial by fire. Going into investment banking, I knew nothing about real estate. And just by random chance, luckily, I got assigned into a group that does a lot of capital raising for real estate development. We did a lot of other stuff. So we'll merge companies together. We'll do restructuring if a company goes bankrupt. But a lot of what I did was raising debt and equity for these real estate developers. So I really learned that game. And it was something that I didn't even know how it worked originally. You see all these commercial buildings, apartment buildings, industrial warehouses, self-storage, all this stuff. I had no idea that these investors just owned these assets. So I got really good at that. Went to the buy side, acquired $1 billion in real estate. And then I couldn't stop there because I was thinking, hey, there's one more link up this food chain, and that's development. That's like the highest risk, highest return bucket that's available in real estate. It's feast or famine. And so I networked enough internally at the firm and got into a development seat where I sit now. And so this involves, you're going out, it's basically playing Monopoly every day. You go out, you see a piece of dirt and you buy it, you put a building on it, you find a company to rent that building from you. And then once it's up and running, you sell to an investor, you make your spread and you're on to the next deal.
Wow.
Yeah, so that's how that's start to finish, how I got here.
Wow, that's nice. So in that current company right now, is it King?
Yeah, Kingsbarn. Yeah, Kingsbarn Realty Capital. That's the parent company. We do everything. So we have like ETFs. We have private equity funds that do things. I've worked on pretty much everything that Kingsbarn does. I've had a chance to work on. But yeah, we run the gamut.
Okay. So when you were in Kingsbarn, you started off as like in the investment side of things, and then later on you network, and now you're part of the development team, all within the same Kingsbarn.
Yeah, correct. Yeah, so Kingsbarn, what they're primarily known for is what are called Delaware statutory trust transactions, which is like a really kind of niche type of transaction that solves a really big problem. And it's kind of like an underdeveloped market. It's growing rapidly. So what DSTs are, it's essentially like, are you familiar with like how IPOs work?
Yes.
Okay, so an IPO, like let's say Apple goes public, right? now you chop up the entire equity value of Apple into these small little fractional shares that people can buy on an exchange. So a DST is the same concept, except let's say you take an apartment building or an office building or a retail center, and then you acquire that, you chop it up into 100 shares, and then you sell those out to investors that are in a 1031 exchange. So in real estate, it's highly tax advantage, right? Um, so if you have a property and you sell it and you replace it with a new property, you don't have to pay any taxes on it. That's insane, right?
Right.
But sometimes, let's say want to retire, you're tired of answering tenant phone calls in the middle of the night, you're tired of just dealing with all these problems, because real estate is just really problem solving. There's just no one's ever calling you to tell you that, like, hey, you look terrific and like I love your smile. They're calling you because they're like, hey, like there's all these problems, like you got to fix it, like you're the problem. Uh, and so a lot of people just get burned out and they want a more passive solution. So that's where these DSTs come in. And so basically it allows you, let's say you sell a $10 million apartment building. So now you have 10 million of equity, assuming that there was no debt on the deal, and you can redeploy that $10 million, let's say, into 5 different asset classes across multiple different geographies. So it really allows you to diversify into these kind of fractional programs, and it satisfies the IRS 1031 exchange, so you don't have to pay any taxes on it, and then you just kind of get this mailbox money every month. So that was primarily what I was doing, was just going out and finding these kind of mispriced deals, and then chopping them up and selling them out to investors, and then I got picked up by the development side.
Okay. And for these investors here, you were trying to sell it to, are they like mom and pop investors, or are they like investment banks, or like how?
Yeah, they're primarily mom and pops. Yeah, so the big institutional guys, they have all the funds and resources to have property managers and really make them passive. And also those those institutional investment funds have LPs, right? Like, so there are kind of mom and pops behind them that are just getting distribution. So it's kind of the same concept. Like, it's another way to passively invest. But then you're paying this investment company to manage the investment for you. So you're losing out on a little bit of that spread, versus owning directly a DST asset. It kind of removes one link in that process. You're kind of one step closer to the source of the cash flow, and so you get like a marginally higher return for it.
Gotcha. So there's no another step between the asset and the investor that comes in.
Yeah.
So what's the difference between a DST and a REIT, though? It sounds like kind of similar, right?
Yeah. So a REIT, REITs function really similarly, but they do it slightly different, and a REIT doesn't qualify for the 1031 exchange. So
Gotcha.
if you sell a $10 million apartment building with no debt, you take that 10 million of equity, you got to pay taxes on that to redeploy into a REIT. And REITs, REITs are great. They serve a great purpose. It gets you like really easy liquid exposure to real estate, because REITs are publicly traded and there's just lots of liquidity constantly flowing in and out of those assets. So if you say, hey, I own this office REIT and I'm scared of office and I want to go into multifamily, you can sell a giant position in that instantaneously without really taking a big haircut on your price, because there's just so much volume going in and out of those asset classes. So you can move positions really quickly, but you're paying a premium for that in the form of like slightly lower returns. So you're getting like a liquidity premium, and it doesn't satisfy the tax exchange rule. So those would be the primary differences between a DST and a REIT. A DST, for example, there is no liquid secondary market for DSTs, at least right now. There's nothing preventing a secondary market to form. It's just that no one's created one yet. So these assets, once you buy them, unless you can go out and find another buyer directly by yourself, you can't really ever sell it. So that's kind of a disadvantage of DSTs, but you're getting kind of a more premium yield for that risk.
Gotcha. And then in the DST, you guys as a manager and operators, you manage everything, while the investors are just like you say, getting investment like mailbox money.
Mm-hmm.
And when you say 1031, would the investors coming in say they're looking to sell a property of themselves, can they 1031 into a DST as well?
Yeah, exactly. Yeah, so the 1031s are 1031 exchangeable. Yeah.
Okay.
So no matter what your portfolio is, if you want to liquidate and you don't want to just own another asset directly, yeah, you can absolutely just buy a fractional share of
the DST
of one of these DSTs. And typically a DST will have, I think, the type of offering that we do, the SEC limits it to 100 shares. So whatever the equity value is divided by 100, that'd be like the share price of a DST.
Interesting. Okay.
Yeah.
And does an investor coming in, do they need to be accredited or non-accredited as well? How does that work?
Yeah, so accredited investors only. Yeah, so
Okay.
that's another kind of tricky aspect to these private market transactions. So whether it's development or private equity, venture capital, hedge funds, DSTs, any sort of like real estate, those all sit in what's called the alternatives market. So there's the public markets and kind of the mainstream market. Those are like your mutual funds, your like annuities are really insurance products, but like any like S&P 500 or an ETF. Or any share of any public company, those are all open to the public. And these alternative assets, or what we call alts, are kind of shielded because there's not as much disclosure and like buyer protections. So like Apple, for example, they have to tell you everything that's going on with Apple. Most people just won't ever read the 10Ks or the 10Qs, but they're required to actually just tell you like, hey, straight up, like, here's where we're at, here's where we're going, here are the risks associated with this, like, here's where things could go good and here's where it could go bad. But in private markets, that disclosure is not mandatory. You can request that information, and the seller, may or may not give you all the information. So that's why you need kind of like these, kind of more sophisticated teams to be able to kind of go and vet out these deals and make sure that, it's a good deal and not a bad deal.
Gotcha. And
Yeah.
then within a DST, do you guys is it only for one property, one asset, or do you have the DST will have multiple assets within that DST as well, or do you have a DST for each asset?
Yeah. So good question. So you'll primarily see single asset entities, and the reason that is because back to that SEC regulation where you can only chop it up into 100 shares. Like if you have a $100 million offering and you're chopping up into 100 equal units, that's $1 million a unit. So the check size becomes difficult for these mom and pop investors if they're selling kind of like smaller assets to get into this. But we've done both, right? So like an example of this, like I've acquired a lot of, when I first joined, we were acquiring a lot of these medical office buildings. So this would be like a single unit that has multiple tenants. Medical office is great because these tenants are a lot stickier, right? Like they come in, they have to like completely rechange the space, right? Like a medical office, like a doctor's office, looks way differently from a corporate office or like a call center, right? And so you have to build out the space. It's really intensive. You have to make a lot of modifications. And so they just really don't want to leave. And so we thought, hey, with all the headwinds towards office, that's going to drag down the price of these medical office buildings kind of synthetically, even though that we think the risk isn't as great as like a building full of a call center, right? Because those are just cubes and phones. Those are really easy to move. So we did a lot of those deals, but then eventually we started doing these big portfolio deals. So we had one deal, I think it was called like KB Diversified 60, where we bought like 10 individual assets, pooled them all up into this one portfolio, and then chop that entire portfolio up into fractional shares. So yeah, you can really do anything. It just kind of becomes there's like a almost like a local maxima of price that the buyers can sustain.
Gotcha. Okay. And you say it was more than alts. So in my experience, when I hear alts, it's like mostly like people can use like self-directed money to be able to invest in something like that too, because like Fidelity and everything, like you say, they're all like mutual funds and ETFs and all this stuff, right? And I came across something called self-directed, and I didn't know about it. And you can use that to invest in alternative asset classes
Uh-huh.
like real estate. Can someone who's accredited have a self-directed? They can also use that to invest and come in.
Yeah, so I'm not sure how the mechanics would work via brokerage, but I do know a lot of these brokerages will consolidate the P&Ls and the economics of those alt investments into your main dashboard, so you can see it all in one place.
Gotcha. Okay.
But yeah, like the mechanics for like most of the stuff I work on, it's like just direct cash injection. So it's like I go to an investment fund or I go to a private investor and say, hey, I'm going to work on this deal. I need a check for $10 million, and they'll just wire that money directly into the entity. And we have an operating agreement that kind of, dictates, hey, like here's how money gets distributed. Here's what happens in upside and downside cases, all that stuff. So it's all papered up, but it's not like something that could be like marked to market. in a brokerage account, basically.
Gotcha. Okay. And so you guys have a portal where they can log in, they can read the PPM, everything,
Yeah,
and
exactly.
see what it, and there's like a webinar or something, and they get to know, and then from there they can invest their money
Uh-huh.
in through the portal. And in that portal, you guys go through the accreditation process as well
Uh-huh.
to make sure.
Yes, yeah. So we have an entire team that does that. I'm not involved with that part of the process, but yeah. It's really strict. Like you don't want to take any risk of like taking a non-accredited investor just because that can blow up your entire operation. So there's really a huge incentive to make sure that you're following all the compliance policies and everything like that.
Gotcha. So it's I'm pretty sure I get so it's a 506C kind of raise,
Yeah,
right?
exactly. Yeah,
Okay.
yeah.
And in your experience, like what's the process you guys take to be able to raise the capital? Like how do if you can tell us like your step by steps and your processes on how you do to go out and try to get investors to come in and check out the one of the asset classes you guys have.
Yeah, sure. So like on a DST, for example, like we have like an internal sales team. So in the state of California, that's the prime that's like the majority of where our investors come from, the state of California. There's a regulation there where you can sell these investments as a real estate broker.
Mm.
So we have a team of real estate brokers that will go out and sell these investments with other brokers to their clients. And then in the other 49 states, you have to go through a registered broker dealer. So that would be like a full-on
Oh,
investment
okay.
bank. And so investment banks will chop those up, sell them to their clients. What I do now on the development side is all just via private placement. So, if we're working on a transaction and, we need some sort of, outside equity, whether that's preferred or LP or anything like that, we'll just go directly, to an investment fund that does equity injections, and we'll offer them the offering, and we'll chat through it like that. It's a bit of a different process. So with the sales team, there's like I'm not really involved with that. So they're they have their whole process of how they find investors and all that stuff. Versus where I'm involved on the capital raising for development specifically, we just communicate with decks and models. So that's all we do. So if I'm out raising money, I have my underwriting and I have my kind of pitch deck of what the deal is, and I'll send that to the analyst or the acquisitions guy at the the equity or the debt fund that is going to invest or lend money on the project. And then we'll just chat on the phone. We'll talk about it. We'll go through some diligence, and if they choose to accept, they'll go through and wire the money in, and then we're off to the races.
Wow. Okay. So it's pretty seamless then. You guys
Yeah.
have everything like spot on already. And you mentioned equity and debt funds. So you guys are open to reaching out to other people who will either do equity or debt fund or both.
Yeah. So it really just depends on the deal. Like I know for the types of projects that we're working on right now, uh, there's so much spread in the deal, essentially, where um, the lenders will give us a lot of leverage. So, construction debt right now, and there's different types of lenders, right? So kind of starting with like the not so sexy kind of boring stuff. So commercial banks, like they'll give you, let's say like right now, they'll give you like 55-60% leverage. So like if you're working on a $10 million project, they'll write you a check for, $5.5-6 million. It's good, but then you have to put in, $4.5 to $4 million of your own cash. That's
Mm.
a lot of money to deploy all at once. Um, and especially as you scale up the deals into 9 figures, right? It becomes unsustainable. You can't just put all the firm's equity into one deal. So the banks will give you the lowest interest rate though. So they might give you 60% leverage at, let's say, 8% right now, versus a debt fund. And just kind of as an aside here, so pre-financial crisis, banks could do all this stuff. Like they could lend you like just an insane amount of money because they had different buckets of risk. But post-Great Financial Crisis, the regulators stepped in and said, "Hey, you can't do that anymore. You can't just take like infinite risk with deposits, right?" And so that kind of cut off that whole high leverage section of the financial sector. So then you had what's called private credit, almost as like a counterparty to private equity. Private credit cropped up, and what they do is they'll raise money from investors, and then they'll have a lender, like let's say like Wells Fargo, with a line of credit behind them. So they'll lend you money, let's say 90% leverage. So now you're doing a $10 million deal. They'll write you a check for $9 million. You only have to put $1 million in, and but it'll be at like 12% interest. So the interest rate, yeah, it seems high, but if you're only in the deal for, let's say, less than a year or like 18 months, it's more sustainable, right? If you can get the deal done really fast and really efficiently, the high octane debt doesn't hurt you as bad.
Okay.
And so, and these debt funds, so I'm like a huge nerd with finance. So these debt funds, so they'll lend you the $9 million, but they'll only put in, let's say, like $4.5 million of their investors' money into the deal, and then they'll borrow the other $4.5 million. And so it's like leveraging their position. So that turns into, like, let's say, a 20% yield note, right? So
Okay.
they're making, an egregious amount of money on their side just from using leverage. It's obviously more risk, right? Like if there's a big collapse and a lot of their projects, foreclose and are not able to liquidate them, then they blow up too, right? But
Right.
just for the time being, yeah, like they're making a lot of money in these leverage funds.
Okay. So even the debt funds are getting out, not even using theirs, they're going out to find other people to come into their funds to be able to invest in something that you have.
Yeah,
Right.
yeah, and that's what's so fun about development is like you're like steering this project, right? Like you are crazy enough to go take the risk because it's really high risk. Like with an existing building, it's sticks and bricks. It's already existing. There's like a ton of value of collateral there. There's people paying rent. Like it's kind of self-sufficient at that point. But with development, you still have to borrow all that money, but then you're borrowing money on a piece of dirt. Like it's not worth anything at that
Mm-hmm.
point.
Okay.
Like land has some collateral, but it's highly volatile, and it doesn't actually become worth something until you finish the project. And so it's like, oh my gosh, like super high risk. But because you are taking the risk as a developer, then like there's this entire ecosystem that kind of like follows along with that. So then you got these lenders, right? Like these lenders then employ people and they're taking on investors. Investors are making money on those deals. And then you have brokers that are selling the deal for you. You have insurance people. It's like this entire real estate ecosystem is kind of then, really there from developers. So it's kind of a cool feeling.
Oh, okay. And you mentioned before you went out and raised all this capital, like what is the greatest advice that you can give in terms of people want to raise capital for their deals? Maybe they have a fund of funds or they're trying to raise fund for another fund. And that's where I'm coming in right now. So I have a fund of funds for a parent fund for the Dallas deal. Like what will you give advice in terms of like how to go out there and find the LPs to come in for your small fund for the bigger fund?
Yeah. Yeah. So raising money, it seems daunting, but because it's just like, oh my gosh, like how do I give a stranger to like write me a $10 million check? Like, oh my
Yeah.
gosh, but it's actually a lot easier than it seems. And it's due to the fact that people want to invest in stuff. That's the whole mechanism of capitalism, right? Like excess funds have to get deployed because if it just sits there, inflation will eat you alive. And it, and so just intrinsically, people want to bet on things. And so what you need to do, I guess, if someone's just starting out and they want to raise some money, it all starts with the underwriting. You got to get good at financial modeling and be able to know what a good deal and what a bad deal looks like. And you have to be able to know how to remove the emotion out of the underwriting as well. A big thing I've seen, I've had the opportunity to work with tons and tons of different investors. And one thing that you will see is that when someone wants the deal to work, that's bad. Like if they're just like really married to this deal and like emotionally invested into it, that's not good because then they're going to make assumptions. The models are only as good as the assumptions are. The math is what the math is. Like people think like, oh, like finance, it's a lot of math. It's like addition and subtraction. Like it's really simple math wise, but it's the assumptions that you're making that come from like the analyst or whoever the underwriter is that will make and break the deal. So if you're really stretching and you're saying like, oh my gosh, like I'm going to set the record on sale price and like yeah, like hey, the population is going to grow by 10% a year and blah blah blah, and I'm going to borrow money super cheap. Yeah, on paper you can make a deal look incredible, but the reality is that the deal will do what the deal does, independent of what your model says it'll do. So the idea is you want to get your model as close to reality as possible. You don't want to like overfit it and make it look terrific. You want it to be real, because then when you send that off to the investor, especially if they're like a high net worth individual, like let's say a family office or like a small private equity fund, these guys are sharp. Like they're really smart. because you're in the equity position. So you get wiped out to zero if something goes wrong. So like you got to be really, really, really on top of it. So once you send the model and the pitch deck off to these guys, if they can go through and vet and say, hey, like, I agree with these assumptions, I'm comfortable with the underwriting, that's pretty much the ticket, because these guys have a mandate that say like, hey, like I have $100 million to deploy, and if they don't deploy it fast enough, they actually get penalized for it. So they have an incentive to like put money out, and all you need to do is just show them a deal that that they agree with, that kind of fits their little box that they need to invest in. And so yeah, so raising money really comes down to you have to get good at the underwriting. You know what the market terms are. So like like development spread, which is the difference between like your yield on cost and the market cap rate. You got to get good at figuring out what the projects will cost, right? Like working with the general contractors, getting several bids, just making it as airtight as possible. Once you can get that down, then it really becomes as simple as picking up the phone and just calling these people. Just start shooting out the deck and the model to these different buy side funds, and eventually people will say, "Hey, like this is something I want to put money into," and it really kind of becomes that smooth. Either that, or you can work through a broker, like go into an investment bank and say like, "Hey, like here's my deal," and they'll put it out to their firm. They're going to charge you 3% for the equity or 1% for the debt. But yeah, it really isn't as daunting as it might seem.
Okay. How would you try to raise that through like a private person, like a high net worth individual, like accredited, like a doctor or a lawyer,
Mm-hmm.
that they depend on you to be able to explain to them in how what makes this deal a good deal for them to invest? How do you approach that?
Yeah, so yeah, with like dentists, doctors, and lawyers, like that's a big group, and those guys have a lot of money. They're usually always accredited. Um, so those folks, you really want. There's a lot of trust in that space. So kind of my earlier example of like, yeah, it's just as easy as sending a deck and a model out to the acquisitions team at a PE fund. That's like the institutional side. Like that's pretty cut and dry. But if you're going direct to like a dentist, or a lawyer, it's all about relationships. You know, these guys have to kind of trust you a little bit more before they'll just blindly write you a check, right? So definitely going out and like just networking, going to country clubs. I don't deal a whole lot with dentists, doctors, and lawyers. But a lot of the folks I work with do, and it's a lot of just going and playing golf, hanging out, really just building deep trust with these guys. And once they trust you and you can explain the deal in really simple terms, then that might be something they invest in.
Gotcha. And that's funny because that's what Jackson was saying too. Like you want to make this as a country club, right?
Yeah.
So yeah, so I appreciate it. But yeah, like how people can reach out to you if they are interested in learning more about the DSTs and try to invest in one of your programs or one of your DST stuff. How can they reach you?
Yeah. Just hit me on LinkedIn, Brett Domer on LinkedIn. Or you can go to kingsbarn.com. So that's the main fund I work for. But yeah, definitely on LinkedIn, like because I'm pretty entrepreneurial. The goal for me isn't to stay as a W-2 forever. Sometimes I have the opportunity to participate in various deals and things like that. So I've saved up quite a bit of equity, and so the goal plan for me, maybe in like 5-10 years, is to be out doing this on my own. And so yeah, if anyone has a deal to do, or they want to figure out and learn more, or they got a piece of land, or you want equity to place, yeah, just hit me on LinkedIn.
For sure. Awesome. Well, thank you so much again, Brad, for your time today. Appreciate you coming over and yeah, answering your questions and sharing your insights. So I appreciate it. Thank you so much.
Yeah,
Yeah, for your time today. Thank
loved
you.
it. Thank you.
Thank you. Yeah, thank you.